Danielle DiMartino-Booth is the CEO and Chief Strategist of Quill Intelligence. She is a full-time columnist for Bloomberg View and a commentator frequently featured on CNBC, Bloomberg, Fox News, Fox Business News, Yahoo Finance, and other major media outlets. Danielle spent 9 years at the Federal Reserve Bank of Dallas, where she served as advisor to President Richard Fisher. She served throughout the financial crisis and the years that followed until 2015. Her work at the Fed focused on financial stability and the efficacy of unconventional monetary policy, and her position at the Fed gave her a front row seat to the extraordinary interventions undertaken during the financial crisis and their ultimate effect on economic growth and economic equality for the nation. Her work inside the Fed is the basis of her book, Fed Up. Love that title, right? Are you with me? An insider's take on why the Federal Reserve is bad for America. Please join me in welcoming Danielle DiMartino-Booth.
Well, good morning again. That was quite the introduction. I'm going to make an attempt to get through my formal remarks as quickly as possible, just while I've been sitting there watching the markets today, and we are having a turnaround Tuesday. Stocks are bouncing hard off their lows. The Dow was at 300 points as I came to the podium. But just as I was perusing Bloomberg's headlines, I'm reading that J.P. Morgan's clients are under extreme stress, that a fund attached to nickel has just blown up and gone away in the space of a few hours, that a major mortgage broker has just fired 3,000 of its brokers, 35% of its workforce. We are in a moment right now. We are experiencing a moment unlike anything that I've seen since we entered the great financial crisis. And what differentiates where we are today, this moment where we are today, and where we were going into the pandemic is the Federal Reserve is trying to go the other direction. They're trying to launch a tightening campaign. They're not in a position where they can launch any kind of an easing campaign because they haven't started to get us out of overly intrusive monetary policy, I would say ... again. So with that, I'm going to jump in. And by the way, Marnie, thank you very much. Dan, Matthew, you completely gracious institution. I'm absolutely thrilled to be here and be here in person, and thank every one of you for being here in case I forget to say it. Well, I think I'm going forward. There we go. So, anatomy of a policy error. Anatomy of a policy error. Ben Bernanke imposed a 2% inflation target in January 2012. In the years that followed prior to the pandemic, 11 times is how often the Fed hit their 2% target. And so it's critical to understand, why do we have the inflation that we have today? Because if the Fed's been effectively monetizing debt, keeping interest rates at artificially low levels for years and years and years, why wasn't it able to create the inflation that it so desired, that it stated that it so desired? Well, the inflation was going into real estate in one cycle. The inflation's gone into the corporate bond market. The inflation's gone into the stock market. The inflation's wildly gone into commercial and residential real estate again. And that's what Fed policy can create, asset inflation. Now, in the New Deal, did I do that? Whoa. In the New Deal, 40.1% of US GDP was injected into the US economy. With the Biden plan and the Trump and two of Trump's stimulus plans, we saw 43.2% of US GDP, and here's the distinction, injected directly into the veins of Americans with the highest propensity to spend the money. So this is your Milton Friedman, too much money chasing too few, and that's why we have inflation today. It is the transmission mechanism of stimulus that's critical to understanding what can ignite the inflation that we have. That is another headline that I read, that small trucking companies have started to lay off truckers because diesel fuel prices have spiked so quickly. We're in a moment right now. So there's always payback. There is no such thing as free lunch, to lean on a cliche. We've gone over the fiscal cliff. We're not paying child tax credits in cash anymore. We're not paying people to not work anymore. We're not paying people's mortgages anymore. We're not paying people's rents anymore. Things that we did for 18 months. I think people misconstrue the magnitude of the stimulus that went into the economy because they just think about those supplemental unemployment benefits that were paid, $2,500 a month, starting in April of 2020 with the passage of the CARES Act. It was so much more than that. A single working mother of two was getting an equivalent of a $61,000 salary. There was absolutely no financial incentive to be in the workforce. And the stimulus went on for such a protracted period of time that Americans, a generation of Americans, have been trained to not be in the workforce. We have 3 million missing workers that are prime working age. 3 million. We have 3 million who are 55 plus, who have retired early, and by the way, they're coming back into the workforce at the fastest clip of any age cohort, those 55 plus. Because we've gone over this fiscal cliff. And we're in a midterm election year, and it looks like nothing's going to come behind it. And this is highly problematic when you ponder the possibility of stagflation, of where the economy is right now, and the narrative changing on a dime from too few workers to too many. It's unimaginable with everything we've seen and the help wanted signs that we've become so accustomed to, and small businesses not being able to secure employees over the last few years, but it could happen in a stagflationary environment. As you can see, and this is something that you can study time after time after time, the stock market is highly correlated with, and I'm sure this is something Matthew and Dan, it makes their head explode, but the stock market is highly correlated with the growth of the Federal Reserve's balance sheet. Period and stop. And this is not a situation where you say causation, correlation, you can't conflate the two. It's not that. It really is a money printing press that has inflated stocks for years. For years. And as you can see, things really took off when we got the printing press, so to speak, running at full tilt. I was intrigued going into 2020 and 2021 that there was this theme in what I call bubble vision, all of the financial media. There was this theme that we were at the precipice of a new decade, of a new roaring 20s. And this was always my go-to slide. How can we be at the precipice of a new decade of runaway risky asset prices when valuations, the price to earnings multiple, was 7 times that of what we saw when it was at a record low in 1920. It just didn't make any sense. Now, of course, you see that we've come off our highs, but still, we're still extremely highly valued. The stock market is still extremely highly valued where it is. And that is problematic. One of the headlines that I saw this morning is that earnings are beginning to be revised downward. This is the first time that we've seen that in years because companies really have had a robust time of cash flow and profit. American families are more exposed to the stock market than they've ever been in US history. The vulnerability, the transmission mechanism from the stock market into the real economy is nothing like we've ever seen. If you look at the post-quantitative easing era, post-2008, when the Fed started increasing the size of its balance sheet, the correlation between CEO confidence and that of the stock market has risen appreciably up to 77%. In other words, the people in charge of hiring and firing decisions key off of what happens in the stock market to make their decisions. And that is not the way that it used to be. You used to be able to say investors can take their losses and it won't necessarily impair the real economy. But that's not the case today because they're tied at the hip, because so much wealth has been created. And you see it's concentrated, as we hear all the time, in the hands of the people who make the most money. And these are just things to keep in mind when you think about this massive millennial generation and the lack of wealth that's been created. And the nihilism, for lack of a better word. You talk to a millennial today, they don't talk about saving up for a down payment to buy a house. They just assume that they're never going to be able to afford it. It's daunting, because that is the pathway to building wealth. That's your first step. You save the money, but they're paying so much in rent. And they see home prices for little hovels that are, I'm preaching to the choir out here, goodness gracious. I mean, I thought it was bad where I live in Dallas, but it's ridiculous out here. But how do you approach procreation? How do you approach wanting to have a large family? Because where are you going to put them? So these are all backlashes of Fed policy, of things like the Federal Reserve stepping in and buying 1/3 of the mortgage-backed securities market in this current cycle. That really does inflate and push speculation. Investors are 1/3 of the market right now. Investors of every housing transaction in America. And they're backed by leverage. And they're spending other people's money. So when you see all these cash transactions, those are investors. And they've been invited into the party by overly easy monetary policy and interest rates at the zero bound that make it very easy for the largest private equity firms to access capital, to come in and swarm markets and prevent millennials from taking that next step forward. As I was just saying, this is another way to illustrate it. We have never, ever seen stock market, and by the way, it's extraordinarily unusual. If you look at the red line, it's extraordinarily unusual for households, the value of their stock holdings to be higher than that of real estate, because real estate is supposed to be the biggest asset on your balance sheet as a household, and yet here we are in a very distorted environment. Oh. Well, I just got to my punchline there. Well, I'm trying to go backwards, but I have a hard time going backwards. Well, I really did jump to the very end, didn't I? Well, I was just, you know what, I'll just jump in here. I was just saying housing affordability has never been this challenged, especially for millennials. And if you look at that tick up, the median mortgage payment for a first-time home buyer of $1,200, that's simply game over for a lot of young people. And they haven't had to pay student loans for several years. So, you know, their financial wherewithal isn't even what's advertised, because one of their largest expenses has been put on hold to the tune of $36.3 billion in foregone student loan payments that haven't been paid. So that's been its own subsidy provided by you and me, the taxpayer, the $30 trillion debt that doesn't matter. It does. It really does matter. And it matters at times like this. It matters at times like this when you see dividing lines and you see China and India siding with Russia. I mean, we're living in a moment right now. And a lot of it has to do with the future of the dollar and the damage that Federal Reserve policy has inflicted on our currency. So this gives you an idea. A raise of hand. I know we've got economics students in the audience, and yay to that. A raise of hands, who's familiar with the term behind the curve? Okay, then I'll explain it. Behind the curve means missed opportunity. It means they had the chance in 2020, late 2020. They had the chance, Federal Reserve officials, Jay Powell, in 2021. There were a few mavericks who were saying, we don't belong in the mortgage-backed securities market. We need to pull back. Inflation really is going to become problematic. This is pre-Russia's invasion of Ukraine. And now we've really got a huge problem on our hands. Because in the 70s, if you go back and study the textbooks, we only had an energy shock. It was an isolated economic event, and it was disastrous at the time. But we have an energy and a food shock together. I'm hearing things from people. I'm stocking up my freezer. I'm preparing. I'm planting a garden. This has happened. February 24th was like 5 minutes ago. And yet, that's how quickly food inflation that was already at record highs has been amplified. President Biden signed into law a 25% increase in the food stamp program. We've seen food inflation rise at a higher pace than the rest of the world, and that's saying something. That's saying something. And it does not, remember, inflation is the most regressive tax. So these are two illustrations of housing and how overextended housing is. If you look at the standard deviation that beyond the mean of, we call it the Z-score, of the 12-month change in U.S. homes under construction, which right now we are constructing more homes than we have in the United States since any time since 1974. But demographically, we're not where we need to be building all of these homes. We don't have a baby boomer generation that's about to come into its own and make a lot of money. We have a millennial generation that has a lot of debt, and we have a country that has a lot of debt. But when you add that to the 12-month change in mortgage rates, we're in uncharted territories. And again, just look me up in a year. Just say, hey, Danielle, just reach out to me on Twitter. You know that thing where I thought you were nuts because we were going to go from talking about an unavailability of labor to having too many unemployed workers? The same plays out for housing, even though it's impossible to conceive right now because nobody can get their hands on housing. And yet, I just heard from a colleague that Tampa Bay realtors are trying to cover up how quickly home prices are falling there. Again, when you pump leverage into a system, at some point something breaks. So this is fascinating. This is the investor community that I was talking about. You see in 2010, 14%, 21%, 25%, 30%. Those numbers are, this is what we call predatory lending. If you look at the percentage of homes purchased in African American neighborhoods by investors and compare that to other zip codes, it's astonishing. It's simply astonishing. And we want for America to be a place where the ladder is there to climb for all cohorts. Because the more productive we are, the more employed we are, the better off we are financially. In the aggregate, the better off our economy is for everybody. And that needs to be understood. Opportunities must be there for all. And yet, these are things they're staring policymakers in the face and telling the Fed, refuting the Fed's policies, saying we don't belong there. We don't belong in a position of inflaming speculation in housing. And as you can see, household buying conditions, the turquoise line, they're simply, they've never been this bad. And at the same time, if you look back to the housing bubble, we thought it was bad with the purple line being so far above the orange line in terms of you have to pay so much more for a home than what you're making. And we've completely gone off trend in the last few years, in the post-pandemic era, when Fed policy has run completely off the rails. There's no title to replace Fed up without, in polite company, So we had the subprime crisis, and that was where the risk lived. Matthew can tell this story with his eyes closed. On Halloween 2018, the debt of General Electric was downgraded by Moody's. Within 14 days, overnight, General Electric's debt was trading like junk. Within 14 days, high-yield bond issuance froze for a record 41 days. We didn't have a single junk bond sold in the country. We had the bloodbath in the stock market. As a result, credit feeds the stock market. So we had this major decline on Christmas Eve 2018, and on January the 4th, we had the Powell pivot. And he apologized and said, we can do QE. I was wrong when I was young. I was wrong to say that QE would be habit forming. So we had the Powell pivot, and markets have really not stopped running since then. But my point is, we resolved a problem with the subprime crisis by creating a new bubble in corporate credit. We crossed that, I'll never forget, it was February the 19th, when the stock market started to crash, 2020, that I came across a headline that said corporate credit crosses the $10 trillion milestone. 2 years later, 12 trillion. So we've solved an over-indebtedness problem by creating more debt. And this is why I tell you this. This is that is the US credit curve. That's the difference between maturing bonds. Triple B borrowers, that is right at the cusp between investment grade and junk bonds, right at that border. They're the ones who have benefited the absolute most since the Fed rode to the rescue. But as a result, they've issued billions, trillions of dollars worth of bonds, and the problem that Jay Powell faced in late 2018 has only been exacerbated. And that's what we're starting to see play out in the junk bond market today, yesterday, since the Russian invasion, since the Black Swan event, the second Black Swan event since the pandemic first hit. But again, when the pandemic hit, the Fed was in a position and preparing to ease policy. Today, we're talking about March 16th, next Wednesday being the first interest rate hike in more than 3 years. So when you hear the term, and you will hear it increasingly, I can get to the next slide. Whoop. When you hear the term that the Fed is going to be tightening policy into an inverted yield curve, that means that the differential between the yields of the 2-year and the 10-year Treasury, to cite the one that's most often referenced, is within the 25 basis point rate hike that they're anticipating making next Wednesday. Every time we've had an inverted yield curve, we've gone into recession in this country. It's just kind of how things are done. Banks can't make money in these environments. I was just reading another headline that initial public offerings, bond offerings, all of these investment banking lines of businesses have frozen solid. That's problematic, and in an inverted yield curve environment, it's very difficult if you're a banker to make money, which I know there are a lot of bankers in the audience, and I know you know exactly what I'm talking about. It's a very unusual and bad environment for your margins. But the Fed, I think, has to go past this point of no return, because unlike any time since Alan Greenspan came into office August the 13th, 1987, unlike any of those moments, inflation was declining. And so now Jay Powell has to choose between two bad choices, because inflation's not falling, it's rising. And it looks like it's going to be rising for longer than they had thought it was going to be. If Powell rues one word that he has ever said as it pertains to inflation, it will be transitory. Because that could well be what he's most remembered for being incorrect about using the term transitory, which we think of in terms of months, not years. And yet here we sit, continuing the discussion about the idea of permanent versus transitory. Matt, I'm going to look at my clock real quick, and I may cut short my comments because I'd love to have an opportunity for some questions and answers with you. So these slides will be sent to you, and that's the good news. This is, very quickly, this means, okay, more from the economics students and law of diminishing returns, anybody? Law of diminishing returns. Okay, good, yay, good. This basically is a graph that shows that for every dollar of debt that the United States has taken on as a factor of time, we get less bang for the buck. And the only thing that's on our side is the fact that we're the most attractive horse in the glue factory. And we can say with great confidence, but it's worse in Europe and Japan. Woo! But that is where the law of diminishing returns is something that it grows exponentially as your debt grows. So when you hear debt and deficits don't matter, don't believe it. But it helps to be the most attractive horse in the glue factory because we have the reserve currency status of the US dollar. But that right now, that hegemony is being called into question by the dividing lines that we're seeing in global financial markets between China and Russia and India. So pay attention to the headlines right now, because I promise you we're in a moment. And this is not the time to mute your Bloomberg, so to speak. I watch it too much, but anyways. And this is my final thought. I will leave this there. It's just for Nancy Pelosi, by the way.
So thank you so much for being with us today and sharing these insights. Some people in this room have suffered for years with Dan and I sort of pounding on the issue of monetary policy and the extraordinary interventions. And that's one thing I just wanted to give you a chance to repeat as a point of emphasis, is when you look back at 2008, the time you were in the Federal Reserve working with Richard Fisher, through 2012 and then the extraordinary events of the fall of 2018, just speak again to the nature of the policy interventions that were undertaken. I think to a layperson that's just reading business journals, they think, oh yeah, well this is a little different than anything we've done before. You know, quantitative easing, the zero interest rate bound, paying banks interest to park money at the Fed. Is this a little bit different, or is this, to use the...
I mean, if it wasn't for the post-pandemic marriage of the United States Treasury and the Federal Reserve, I would say that that was as far as I thought it could go, that we could go into crazy land. When I was at the Fed, when we were launching the first generation of quantitative easing, the Fed buying corporate bonds was debated and roundly rejected. The idea of the Fed intervening in the municipal bond market, which it has done in the post-pandemic era, that was like an absolutely not. And it was a huge internal debate at the time that the Fed should, and this is in the Federal Reserve Act of 1913, by the way, it's illegal for the Fed to do what's called credit intervention. So technically buying mortgages to intervene on behalf of a cohort of borrowers, which is what we did in the first generation of QE, that was technically illegal. And I think that when the dust settles on history, that we will find out that what the Fed did in a post-pandemic era was also illegal.
Okay, all right. So obviously our audience is used to us presenting really difficult data, right, and the story behind those, but and there's nods heading. Hi, Rosemary.
I tried my best to speak in English, I tried.
And the answer we're constantly getting from you know, our the people we have relationships with here in the community is, okay, so what? And so the question I have for you is, and I've heard how you've answered this in other contexts, but I would love them to hear is, so if we made you president of the Federal Reserve Board for a day, you know, what is the way forward, right? How do you break this cycle? And maybe even speak a little bit to what the consequences would be, but what's the answer?
Well, the answer is a heck of a lot more difficult than it was in July 1979 when Paul Volcker took office, because debt to GDP was only 31%. And now we're at 133%. So being the chair of the Fed and having the fortitude to put the United States into recession, which Jay Powell was asked directly in front of Congress last week by Senator Shelby, are you as strong as Paul Volcker? Do you have it in you to put the United States economy into recession? Because that's what's needed. Because either we have a recession and get through it and get rid of the zombie corporations that are now 20% of corporate America, one-fifth of US firms don't have the cash flow to cover their interest expense. They've been kept alive by virtue of the junk bond market staying open so that they can constantly refinance their debts. So you would have to put the economy into recession and pray God that it wasn't a crisis or a depression, and let the deadwood be cleansed from the system. You would set the federal funds rate at 2% and vow to never go below that again, so that your banking system functions properly, so that you don't encourage malinvestment, as von Mises would have said. And you would vow to never, ever blow up the balance sheet.
to stay away from quantitative easing, and you would go hat in hand to Congress and say, get rid of my second mandate of the employment mandate, because it inherently conflicts with that of maximizing employment, inherently conflicts with minimizing inflation. You cannot pursue the same two at the same time, which is exactly why we also have this inflation today.
Well, so one other thing I wanted to talk about too is how about the Constitution of the Fed itself? I've heard you talk about the role of academics, and this is something you touch on in the book a lot, but also about the need for more practical people making. So why don't you speak to that?
Well, I mean, somebody might argue that 786 or so PhDs might be a bit concentrated in one organization, me being the first. But no, having people go straight from academia and never, like your newest member of the board, apply it to the real world and then bring the real world back into the classroom for students, that's so critical. And yet, the Federal Reserve is mostly populated with individuals who've never had to make a payroll. They've never had to run a business. They don't understand what their policies, how their policies manifest in the real world. Mm-hmm. And you know, they've mostly gone in Chicago, MIT, Stanford, they all think the same. And in the book, I call it group stink. You cannot have group stink. You just can't have it. And you can't have a bunch of academics running the most important institution on planet Earth and be so disassociated with the policies that they make. And it feels good for everybody, right? Because the stock market's up, my 401k is big, my home value is great, it's all wonderful, that's great. But then you look at the underside and you see this stagnation demographically, and that is a vestige of Fed policy. Yeah. Now, if anybody's got Waze and can tell me how far away LAX is in terms of minutes, that'd be great, because I'm not leaving until I get a question from a woman.
All right, let's do.
Because it's the day.
Does somebody have a question?
Well, I didn't say that. I said, did a woman have a question?
Okay. Does a woman have a question?
Great, wonderful.
I'm in international trade too, so it's apropos. But I'm curious your thoughts on crypto economies or Bitcoin, and how does that fit into it?
To me, at least, and boy, I'm sure I'm happy that everybody on my Twitter feed from approximately midnight to 5 a.m. is not in this audience. They come out at night, all the cryptos. They come out in the middle of the night with their tinfoil hats on, and they're, don't you understand you don't need to go to school because you can make billions of dollars every single day. And Bill Gates is just like everybody else because you don't need to go to school because of Bill Gates too. Anyways, I look at Bitcoin as being a reflection of the rejection of fiat currency. And people want for there to be an alternative. They want for there to not be, since, Rome fell. They want there to not be the transition of one reserve currency to another to be the result of a hot war. But since the fall of Rome, that's how it's worked. So we got British pound sterling as a result of a hot war. And this idea that hot-headed leaders of the world are just gonna say, sure, you take reserve currency status. Because, but that's the theory, and it doesn't hold water. It hasn't been regulated internationally yet, but we have certainly seen regulation begin. And this Russian moment is, I think, going to increase scrutiny on all cryptocurrencies. So it's way too volatile to be a store of value, and that, in my bones, that tells me that there's something wrong with it. The fact that it's correlated most closely with the NASDAQ, with technology stocks, that's not typically how currencies behave. You don't want that kind of volatility. And more than anything else, if I look back to 1999 and 2000, and the adamance and the anger of anybody, you might be like, well, that Qualcomm valuation looks a little, what about that Pets.com? No. The anger that people had, that it's different this time. And I get that same level of anger from anybody who, if you question cryptocurrency, it's that same defensive mechanism. They're like, we're right, you're wrong, end of story. And it's just as frustrating to hear as when you're a kid and you're like, well, why, Mom? Why, Dad? Because we told you so. Which, it's not very satisfying. Great question.
We have time for one more question. Nick?
I'm not in the
I'm not an economist, but I play one on TV.
Asking, who is affording all of these houses that are selling for 4 times what I can imagine paying myself? And of course, they couldn't afford it. It seems to me we're kind of in a similar, maybe it's the mechanics are different, but it seems to me we need a crash. We need an adjustment. It's wrong what's happening right now. I don't understand it, but it's wrong.
Residential real estate is definitely, for God's sake, I'm in California. I thought this is where disruption lived and was born. Residential real estate needs to be disrupted. The way it's transacted, the way the real estate community, the fact that the National Association of Realtors is the largest lobby in the country. I mean, there's something wrong with that. And what people don't understand about housing is it's pro-cyclical. They think that it's a store of value and that it's going to be a shelter from the storm when your stocks blow up or your bonds blow up or your 401k goes south. It doesn't. Look back at the last, 100 years of US history. Housing moves cyclically with risky assets. And you are right. We need a correction. And I'm gratified to see certain cities and towns start to say no to investors when they want to come in and build a subdivision and keep families as renters for the rest of their lives, which I think they call that serfdom. So I'm gratified to see cities and towns begin to push back against this investment army because it's the antithesis of the American dream and a way to store value and pay off your mortgage before you retire when you're 65. I mean, who does that? We have people who are in their 80s with mortgages. There's just something wrong with that construct.
Well, we want to be very sensitive to your time.
Yeah,
So
I tell you what, I'll look at Waze. We might have time for one more. Well, you think I'm kidding. 56 minutes? Oh, I've got time for one more. It was an hour and 4 minutes when I first took the podium, so we've shaved 8 minutes off.
We've been warning her, it could be 56 minutes, but it could be 3.5 hours.
And I'm headed into a winter storm. I'm speaking in the morning in Bozeman, Montana. So it's going to be -7 tonight. So wish me luck. Not quite California's weather, but yes. Yes, in the back.
Speak up, yeah. Please.
Shout it loud and proud.
There's been discussion that the Federal Reserve could be taking into account the fact that the debt is so high that if rates are
Great question.
raised to the level at which we can't possibly manage that debt and service the debt. So how much do you think that's weighing on that?
No, I mean, normalizing interest rates would make the debt of the United States impossible to service. Impossible. You would have to see federal tax rates go just to the moon, just to even contemplate. So the same goes for corporate America. The same goes for many households. In the past few months, since the child tax credit stopped being paid in cash, that last payment was December the 15th, we've seen a spike in subprime car loans delinquencies. We've seen a spike in subprime credit card delinquencies. So you're right. The Federal Reserve is trapped, but they're trapped of their own making. But again, this is not Alan Greenspan, and inflation's not coming down right now. So they may have to hike into a recession. But what they can't do is break the credit market. That's what they'll have to stop short of breaking the credit market. And be very careful about that. I'll take one last one.
Great.
Yes, in the red sweater.
How should local governments invest the ARPA money that they just received?
Oh, boy. I'm going to quote my old boss, Richard Fisher, and he was once asked, kind of at the precipice of the crisis, so what position is your portfolio in? And he said, well, it's in the fetal position. This is not a time, this is not a moment to listen to your financial advisor who's saying, just stick it out, unless you just want to stick it out and never retire. So there's nothing shameful in having a large portion of your portfolio at these moments in cash. Nothing shameful at all. And that's what people have to understand. I'm not suggesting that markets can be timed, but I am suggesting that when valuations are 7 times that of December 30th, 1920, that there might be something problematic in risky assets. And we do know one thing, and that is when one breaks, the other breaks, and correlations line up to 1. And it's very difficult to find a place to hide outside of the 30-year long bond in gold. And that's just reality.
So please, please join me in very, very warmly thanking Danielle DiMartino-Booth. We really appreciate you. Thank you.
I'm going to LAX.